only ding to your credit report, and the remaining 4, when they pull your credit, it's not going to affect your score whatsoever. And only consumer authorized inquiries for new credit will affect your score. Now, on that point, I want to talk about an example that I'm dealing with right now. I've got a client that I'm doing a mortgage for, and about 2 months ago, he thought about buying a car but then decided against it. But he went to 3 or 4 different dealerships, and he had them pull credit, and he, to see if he could get the best financing options. But he chose not to purchase the car. So when we got him approved on his credit report, the underwriter asked him to explain those inquiries, basically wanting to know, if he'd bought a car, or because it's not showing on his credit card. If he did, how much was it? So he had to explain to her that he was thinking about it but didn't, and he wrote a letter to the underwriter. Now, the problem with that is some underwriters might think, well, he's just holding off to keep his debt ratios down until until he closes on a house, and then he might buy the car, and then his ratios won't be in line anymore. So if you've got clients out there or just considering looking to purchase a home, I would be very wary of shopping for major purchases before you buy a home or close on that loan. In most cases, the score impact by an inquiry is minor. Between 2 to 5 points is normal for one inquiry. It is only in rare cases where there is little or no information in the consumer's file. It's only in rare cases where there is little or no information in the consumer's file that a single inquiry is significant. That concludes our presentation, and if you have any questions, I'd be happy to answer them.
Our first question this morning, I have a friend that recently went through the mortgage approval process by shopping 3 different lenders over a 2-week period. All 3 lenders represented her credit scores differently. How is that possible?
That's a really good question. If you remember at the beginning of this presentation, I talked a little bit about how a person's credit score is based on a specific point in time. Now, because of that fact, a person's score can be different from one day to the next. For example, let's say her score was pulled on the 14th of the month by the first lender, and then again 3 days later by the second lender. And in between that time, one of her credit card companies reported to the agencies showing a major purchase the month before. Now, what happened there is this caused her amount owed versus available credit ratio to jump from 35% to 60%, and that probably that could cause a noticeable impact on her score.
Another question. I have 6 credit cards but only use 2 of them. The 2 that I use are typically close to maxed out, but I don't like to use the others because they have higher APRs. Is this a good idea, or does it hurt my credit score to have the cards maxed out?
Another great question, but it's a little bit harder to answer. While the scoring model takes into effect your total amount owed on all credit cards versus the total available credit on all credit cards, it also looks at each individual account. If the scoring model sees an account that is consistently maxed out, it can have a negative effect. However, it is very difficult to know how negative it will be. I personally like to see the amount owed versus available credit on all credit card accounts below 50% if possible.
Okay, another question. Why are credit scores from the 3 bureaus different from each other?
There are 2 reasons for that. First, the 3 bureaus, which are TransUnion, Experian, and Equifax, each have slightly different scoring models that they use to evaluate a person's credit. A good example of this is TransUnion may look at a 30 days late more negatively than, let's say, Equifax. And the second reason is reporting to the credit bureaus by creditors is strictly voluntary. In fact, the only required reporting is by holders of a first mortgage underwritten by Fannie Mae and Freddie Mac. This voluntary system means that creditors are reporting at different times to one or to all of the bureaus. And because of the different scoring models and the voluntary nature of reporting, a person's credit score is very liquid, which means it can move up or down on a daily basis.
Now, this is a good question. What's the lowest my credit score can be and still qualify for a mortgage loan?
In today's lending environment, a good rule of thumb is if you're looking for a conventional mortgage product, you need to have at least a 680 credit score. Anyone below 680 typically is going to want to go FHA. And FHA right now requires a 640 credit score if you're the only borrower. However, if you have a co-borrower, you can have the primary borrower can have a 620 score as long as the co-borrower has good scores. And another example of this is I'm currently working with a part-time college student that's buying her first home. Her parents have agreed to co-sign the mortgage as a non-occupied co-borrower. She right now has a score of 620, which would have disqualified her if she was trying to buy the house herself. But since her dad is the co-borrower, we're able to do the loan because he has high 700 scores.
Okay, I am young and do not have a long credit history. That'd be nice, wouldn't it? The credit that I do have is current, and I have never been late making a payment. In fact, I usually pay off my 2 credit cards every month. The last time I checked, my credit score was around 645, and I was wondering what I could do to improve my score over the next year.
Wow, this is a very common scenario that I see with young people just starting out. You're doing everything right, but you just don't have enough credit history to build up your score to where you want it to be. The good news is that time will be your friend as long as you continue to pay your creditors on time and keep your debt to available credit ratios low. I would recommend opening up a few more credit accounts and rotating the use of all your accounts over the next year. This will help your history score, which in turn will raise your overall credit score.
Okay, I am currently paying off a couple of finance company loans that I took out to purchase accessories for my work truck. I don't have credit cards at this time and rely mainly on cash to pay all of my living expenses. I have saved up some money for a down payment on a home, but I am concerned that I will not be able to qualify. Any advice on what I should do?
Yeah, the first thing I would do or recommend is for you to request a copy of your credit report with the scores. This will cost you some money, but it is worth it to see if the finance companies are reporting your accounts with them. As mentioned earlier, creditors are not required to report to the 3 bureaus unless it's for a first mortgage backed by Freddie Mac or Fannie Mae. If you see that your finance company accounts are not being reported, you can request that they start reporting them, and in many cases they will honor your request. Now, once you know your credit score, you should definitely seek the advice from a mortgage loan officer to help you see what you would be able to qualify for. If the mortgage loan officer says you don't have enough credit history to qualify, then I would recommend opening up traditional credit accounts, which would include credit cards. I would only use them as if you were paying with cash, making sure you were paying them off every month. Again, time will be your best ally and should get you where you need to be.
We have another question this morning. Is it best to decline offers of increased credit limits on your cards to limit your total available credit if you do not need it? I usually pay the full balance each month.
It really depends on what your credit limit is. I've always been the school is, you never decline available credit. What the credit companies are going to, or what the scoring models are going to look at is, it doesn't matter if you've got $100,000 worth of available credit. If you're only using 5 of that a month and consistently doing that, that's not going to be a negative. That's going to be a positive. However, if you've got $20,000 in credit limit and using $5,000 a month, that might look, a little bit worse. So, I've always believed that you should take the credit up to a point. So I don't know if that helped answer your question, but it's not going to hurt your credit rating to accept the increase in credit limit.
Thank you, Jim. That's all the questions we have received this morning, and I appreciate your participation. We have plenty of webinars coming up, and we are posting them all on the website, davidsonrealtyinc.com, so feel free to check them out at your leisure.